Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is CSX Corporation, ticker CSX on the NASDAQ. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $62 billion, enterprise value of $77 billion, so it means you have about $15 billion in net debt. They're operating the road and rail industry, which tend to be fairly good in terms of it has a strong moat. It's very hard to build new railroads in the United States, so you'd expect it to have a strong business model. So they provide rail-based freight transportation services, rail service transportation, intermodal company trailers, and other transportation services. So they have 19,500 route mile rail work, which serves various population centers in the 23 states east of the Mississippi, DC, and Canadian provinces, Ontario and Quebec. They also own and lease 35 different locomotive trains. So useful information there. Like I said, that sounds like a pretty good business model in terms of it's very hard to build a new railroad. So you should be able to have good pricing power. Now, what's interesting is the first thing I see here on the gross profit is that doesn't necessarily show to be true. Excuse me. So, doesn't necessarily show to be true. You do have pretty low gross profit margins here, but you still have some pretty strong pre-tax income margins. So it's looking like the overhead is actually a really small amount. We'll see how that runs into the business. Now, what you can see that supports the idea of the strong moat is that you have very good stability from year to year in return on invested capital. There's not big swings up and down each and every year. The only swing we see that's really major is 2016 to 2017. That was the year of the tax law changes in the United States. So assume this number has a lot of one-time tax effects, which could be impacting it. So I'm going to ignore that 2017 number. But in general, you see it's fairly flat over time. Now, it has gone up pretty steadily, but again, the rebaselining to this one could just simply be the lower tax rate since 2017, but that you can clearly see the benefit in taking the business from a 9% return on invested capital to 11 and 12%, which is a good 30% increase in the profitability of the business. Very attractive for shareholders. Now, I like everything I see here on the return on invested capital section. It shows a very high quality business. In addition, you're hitting these metrics of 10% plus. When you look at this 10-year median return, you're right at 10% for return on invested capital. That's the benchmark I want to hit. And due to that $15 billion in leverage that I talked about, they're hitting a 21% return on equity number. Very, very attractive. So everything here is suggesting a high quality business. I'm liking what I'm seeing. In addition, the PE ratio of 15/16 is a very attractive number. I like to buy stocks right at this range. So it looks like it could be trading right around fair value at first look, because I like to pay 15 times earnings for the businesses or less that I own. So you're right at that approximate range. It's just within a ballpark of that. A more in-depth earning analysis could give you a better look. Now, what I don't like is the first thing I see here on revenue is you're basically flat on revenue growth and you've been growing your assets over time. If you do that for too long, you're going to have worsening returns over time. However, they're growing their free cash flow and their EPS in double digits despite not growing their revenue and assets. That is curious. I don't really understand how they're growing their earnings per share at such a fast rate without growing their revenue. We're going to have to dive a little bit deeper. Over the long term, you cannot sustain earnings per share growth or free cash flow growth faster than revenue. You can do it for a short term, you can do it for the medium term, but at some point you have to increase the revenue. You can't always be pulling out extra earnings without increasing your revenue. That's not a sustainable business, and you can see what that does over the course of a 10-year period. In 2012, they had $11.7 billion in revenue. 2021, $12.5 billion in revenue. It's very little growth across the decade. You can see sometimes it goes up, sometimes it goes down, but basically flat over the course of the decade on revenue. That's not attractive. Now, what they have been able to do is they've been able to boost their gross profit margin, because you can see that they've grown their gross profit margin from 29% to 41%, going from $3.4 billion to $5.1 billion. And that will explain basically the entire difference between the lack of revenue growth and the massive growth in operating profit. The growth in the margin is driving everything here. But this isn't repeatable indefinitely. Let's say you go the next decade, and instead of going from 29 to 41%, you go from 41% to 53%. You can't do that forever, because you're not going to be going faster. You're not going to get to 63. You're not going to get to 75. You're not going to get to 87. You're not going to get to 99. So at some point, you have to grow your revenue if you want to grow your profits. This is a short-term benefit. Planning for this to repeat even for one more decade is probably not reasonable, but you could maybe make the bet for another few years. You certainly can't make that bet for decades and decades on end, especially because you see the biggest jump came in that 2017 year. And so the biggest rebaseline here looks like it's really maybe taxes. It's hard to tell, but you can clearly see a big jump here on that 2017 year we're seeing. So a one-time impact is making a huge difference. You have to be very careful when you see something like that. And so something to be aware of, and I don't think that this growth is sustainable, which is a concern because I wouldn't pay 15 times earnings for business that's flat revenue growth. I would pay 15 times earnings for a company growing at 11% EPS, but these two don't match over the long term, so it's not something I'd be willing to bet on. Something to think about, something with flat revenue growth is worth probably PE of 8 or less, which means the company's price needs to get cut in half, so from $29 to $14.50. But again, if you have this sort of growth, then the price is reasonable and fair value. So something to be aware of as a shareholder or someone interested in this business. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. By subscribing, you both get access to future videos that I upload, and if you ring the bell, you can get notifications when I upload them 3 times a week, Monday, Wednesday, and Friday. So let's dive on into the income statement. You can see that the way that this business is being structured is they don't have a separate SG&A line, so all of the gross profit is converting into operating profit. That's probably just a quirk of how they're reporting it, but it's something to be clear that you're seeing a big grouping change there. So they've been able to cut their cost of goods sold. For all I know, that's just lower prices on the commodities. It could be fuel. This, again, might also not be a sustainable piece here. What I wanted to see, though, was, let's look at 2017. This is exactly what I thought. In 2017, you had a one-time tax impact. Again, that Tax Cuts and Jobs Act from 2017 is going to distort numbers until it rolls off people's look-back periods. So you can basically ignore 2017. Those numbers aren't real. Now, what you can see is, if you take a year like this, you can see that despite having higher pre-tax income in 2018 than they had in 2016, they had lower taxes in 2018 than they had in 2017. And that's a huge portion of the change in EPS. So again, another reason that this sort of EPS growth is not repeatable is due to this tax law change. So now we know that 2017 was just a blip, and 2018 and future numbers are really supported by the lower corporate tax rate, driving a significant part of the returns. Now, the other part of it is you've tripled your EPS over the course of the decade, 60 cents to $1.80 functionally. And part of that has been because you've, basically gotten rid of 20 to 30% of the shares outstanding. You've gone from 3.1 billion to 2.2 billion over the course of a decade. That's very good. That's going to account for maybe a 3% boost in your EPS, 3 to 4%. So you're getting a 3 to 4% boost from that. You're getting it looks like maybe another 2 to 3% from the net income change, from the corporate tax cut change. And so the sustainable growth that you have, even if we assume that this leverage is working, is maybe 3 to 4%. So this is a company growing at 3 or 4%. It's not a company growing at 11%. And that again assumes that this growing gross profit margin is sustainable, which I have my doubts. Now, the balance sheet. One thing interesting is, despite not growing revenue, you've had to grow your PP&E by $7 billion. So they've increased their PP&E by $7 billion, but they've not grown revenue at all over the course of the decade. Even more concerning, they've had to increase their debt by $8 billion. They've doubled their debt, but not moved their revenue at all. Very, very concerning for the long-term future of the business, especially as interest rates start to rise. You need to be concerned about this as a shareholder. This is the sort of growth in assets and debt against a flat revenue base that would make me not invest in a business. This right here is sufficient reason not to invest in the business because you're growing your assets, you're growing your debt, but you're unable to grow your revenue. That's a very bad sign for long term. In the short term, it boosts earnings because your low interest rates have allowed you to get nice EPS growth. You're able to fund your balance sheet with debt instead of equity, and it looks great. Over the long term, though, it's a massive problem. Another problem here is, of course, you have pretty large PP&E investments that I just talked about. You have these depreciation numbers. It's quite possible these depreciation numbers are understating the true cost, which means you could be understating your income. Rail is a very expensive business, so I would estimate that these depreciation numbers are actually lower than the economic cost for running that business. So it's just something that you have to be aware of. I like these steady buybacks. I like the capital allocation. They're also paying you dividends. But again, you have to be aware of all that debt. I would be much more thrilled about this business if they kept some of these dividends and buybacks and just refused to grow the debt. They paid off the debt. They ran it on equity. Now, you don't necessarily want to do that because then you're going to get low returns. So you need some level of leverage, but maybe holding flat debt to revenue would be a better basis. It's not that debt on the balance sheet is bad. It actually is really good for the equity, but the fact that you're growing your debt without growing your equity or without growing your revenue is where I'm concerned. So that's my summary for CSX Corporation. In summary, I think this is a very strong moat business. It's very high quality. It looks like it's very predictable, has all those signs of what you'd like to own over the long term for quality reasons. But in terms of value, I have massive concerns. It looks like you're actually really overvalued, even a PE of 15, because what this is doing is this is substantially overstating the value you're getting in this business. This 10-year history of growth is overstating the sustainable growth of the business. I'm going to assume it's more like the revenue growth we see here of 1% generally. So if you're going to have 1% revenue growth, you really want a PE of less than 10. You want a PE of 9 or less really to get a good deal. So I'd say you're 50 to 60% overvalued. So high quality business, but overvalued. And for me, I wouldn't invest because I don't like to own businesses that aren't growing their revenue. Ideally, growing revenue at double digits would be my threshold that I'd be attracted in. And this business is simply at scale already, and it doesn't look likely. So for me, CSX Corporation is a pass. I hope you gained value from this content. If you did, hit that like button. Don't forget to subscribe. That lets YouTube know that you're enjoying the content and would like to see more content like my own. And if you hit that bell, you can get notified as I upload new videos each and every week. We are working through every company in the S&P 500, and the first 100 episodes of that have already been published. They're in the playlist that you will see above for the S&P 500 playlist at the end of this video, so please feel free to click that. If you like the software that I'm using, QuickFS is the software, quickfs.net. You can see my affiliate link in the description below. If you click my affiliate link and sign up, then should you ever become a paying subscriber, then I would get a cut of that commission. And so I'd really appreciate your support, because that support helps me to put out this great content for you. It's free. It doesn't have any impact for you. Initially, you can sign up for the free one, just like the content I'm showing you today. And they also have an extra paid subscription. So you can sign up for free, test it out. No issues there. So thank you for listening. And until next time, stop paying fees, start building wealth.